Hey guys, it's Dan here. In this week's episode, let's talk about the beta in finance. So, what is the beta in finance? Well, to understand the beta, I will give you an example of the stock market. So, we will look at different stocks with different betas, and you will understand what I mean when I say the beta in finance. Second part of the video, I will also explain you how the beta can give you a good indication about how a stock evolves, and also I will give you a little investment tip or investment education related to the beta and the stock market in general. All that being said, ladies and gentlemen, let's roll. Okay, so as always on this channel, let's start with the definitions first. So beta, what does it mean? What is the definition? Well, beta means basically or measures the volatility of one stock compared to the entire market. Let me give you an example because it sounds like a pretty fancy definition. So, example first. You're probably all familiar with the S&P 500, which is the sum up, or which is an index of the 500 biggest, most profitable and listed US companies. So basically, to be able to be in this index of the 500, well, you gotta be part of the biggest 500 companies, you have to be listed on a stock exchange, and you have to be profitable as well. This is how you come into this index, okay? But what you have to understand is this index alone, it's basically just a replicate or an average of the 500 companies that are composing the index, right? So here is the first big difference, and this is where beta plays a big role. Basically, the S&P 500, so what you see here, is just an aggregation of 500 individual stock values. For example, you have Apple, Facebook, Amazon, Boeing, Tesla, Microsoft, and a lot more to come to the number of 500 here. And as you can see, they all move into different directions. What it means basically, and the reason why they move into different directions, is because they all have different betas. So now let's talk exactly about what is this famous beta. Okay, so now I will show you 3 examples of beta, and you will quickly understand why beta matters and what it changes basically. So as I just mentioned earlier, the S&P 500 is moving, but it's moving because of the 500 values inside the index which are moving, right? So if you take the beta of the S&P 500, of course the beta will be 1 because you are measuring a volatility compared to the market. But of course here the market, if you're comparing the market to the market, of course you have a beta of 1. So a beta of 1 is like the benchmark. So now let's look at the different companies, because each of the companies has a different beta. So let's take the example of Apple, Tesla, and Bristol Myers Squibb. Apple, for example, has a beta of 1.08, Tesla has a beta of 2.0, and Bristol Myers Squibb has a beta of 0.62. What does it mean? Well, first of all, you can, if you're googling S&P 500 companies beta, you have all the list, and usually what they are looking at is the average of the last 5 years, and they will look at how did one stock, let's say the Apple stock, how volatile was it compared to the market, so compared to the S&P 500. The answer to this was a beta of 1.08 for Apple, which means that the Apple stock overreacted by 8%, 1.08. It overreacted, it's above 1, and it overreacted by 8%, which basically means it's not technically true to say it for one day, but on average for the last 5 years, it basically means that if the S&P 500 went up like this, while the the Apple stock went up 8% more, and on the downside 8% less as well. So this is, to make it very simple, what it means. Let's look at a more crazy example, or a higher beta. Tesla, for example. Tesla has a beta of 2. Beta of 2, it becomes a highly volatile stock already, and you've seen it with Tesla. Tesla went up big time, and also, I mean, the volatility was very high compared to the market. That's why you have a beta of 2.0. That means basically that the Tesla stock overreacted by 200%, so that's 2 times 1, 200%, what does it mean on a graph? It means that the S&P 500, let's say if it went up like this, the Tesla stock went up, well, 2 times this, so this, but also of course on the other side, on the downside, it went down furthermore, of course. And then we have the other example. So this is Tesla. Apple is roughly the same as the market risk, so one close to 1. Tesla super high beta of 2, so very high volatility compared to the S&P 500. And then we have another example from the pharma company Bristol Myers Squibb, which has a beta which is below 1, which means they are underreacting, and they are underreacting by 38%. Why 38? Because 1 minus 0.62, which is the beta, leaves you with 0.38, so 38%. So basically, if a beta is smaller than 1, like the Bristol Myers Squibb one, for example, it means that if the market, the S&P 500 is going up by this, then the Bristol Myers will probably go less. And on the other way, when it's going down by less because it has a lower volatility compared to the market. So now that we have seen the 3 examples, let's do a little bit of theory. What does it mean basically? Well, you have basically 2 cases. Either the beta is higher than 1 or it's lower than 1. And what does it mean? This is what I just explained. If the beta is higher than 1, it means that the stock you are talking about, for example Tesla, has a higher volatility than the market. That means that if the market, for example, is the blue line, let's say the S&P 500, which is going up and down, it means that the Tesla stock, for example, which had a beta of 2, so higher than 1, is going much higher and much lower, but again, not on a daily basis, but on an average of 5 years, for example, okay? So as you can see, it's overreacting. When a beta is smaller than 1, it means that the stock price, let's say Bristol Myers Squibb in this case, has a lower volatility than the market. So in this case, again, the blue line would be the S&P 500, which is moving. And as you can see, the Bristol Myers would move, but less up, less down, because it has a beta that is lower than 1. So now what does it tell us about our investment strategy in this case? So now let's quickly talk about investment education a little bit. I want to show you something on a graph again. I just showed you, but just to showcase you all the 3 examples on one graph. The blue line would be the S&P 500 with the aggregation of 500 values and with a beta of 1 because it's moving to compared to itself, so that's why it's 1, right? Then, of course, you have the Tesla with the very high volatility with a beta of 2. It basically means compared to the blue line, the green line is amplifying the moves. So let's say it's going up crazy high, it's going up crazy low, because the beta is 2. So basically it's exaggerating by 200%, but on a 5-year average, not on a daily basis, of course, okay? So as you can see, the Tesla with the higher volatility is a riskier investment. And then the Bristol Myers Squibb, for example, with a beta of 0.6, as you can see, it's following the blue line, it's following the S&P 500, but it's a softer line. You see it goes less up and down. It's more a steady stream, basically. So what does it mean for investment? Well, of course, it always depends on your strategy and on your horizon. What I do personally is I like to invest long term. I don't like speculation, I don't like day trading. But let's say if you are a long-term investor for your retirement, for example, S&P 500 is what most people do, because the S&P 500 is the aggregation of a lot of values of a lot of sectors, so it gives you great diversification here from all the industries and so on. And with the let's say with the benchmark beta, so there is no huge ups and downs. It's just following basically the aggregation of 500 companies. Then, if on the other side, of course, if you want to do day trading and speculation, then what I would do, I would look at the high beta stocks, of course, such as Tesla. Why? Because if you are speculating on one day, for example, and if you are able, imagine this is like, this would be one day, of course, if you, as a day trader, you are trying to catch the wave exactly when it hits, right? So that's of course that's why it's risky. But as since you're already taking that risk of a small or short horizon, I would do it with high beta stocks where you can, of course, you can have big downfalls because it's kind of amplified, but also big highs. And usually, people who are day trading, they are speculating with high volatility stocks, such as the Tesla stock with a high beta, for example. So this was just my quick analysis to that. I would love to know, were you familiar with the beta situation? Did you know what it was? Is it helpful for you? Are you already investing? Are you more like the day trader, risky guy, or more like the long-term investor? Let me know in the comment section below. Otherwise, I wanted to tell you that I post once a week, every Sunday, corporate market finance. I try to make it high value all the time. So of course, make sure to subscribe, make sure to like if you like that kind of stuff to spread the word. Enjoy. See you next Sunday. Bye bye, guys.